The Indian government recently made significant amendments to taxation rules through its Finance Bill 2023. One particular area that has attracted considerable attention and debate among financial experts is debt mutual fund taxation. This video aims to provide clarity on the new tax regulations and help investors make informed decisions regarding debt funds. Effective from the 1st of April 2023, the new debt mutual fund taxation rules introduced three categories for taxation purposes. Let's examine each category and understand the implications. Mutual funds holding 65% or more in Indian equity ETFs, or equity funds. For this category, the taxation remains unchanged. These funds are taxed similarly to equity funds. Short-term capital gains, STCG, apply if the holding period is less than a year and are taxed at 15%. On the other hand, long-term capital gains, LTCG, tax rate is 10% for a holding period exceeding 1 year, in addition to aggregated long-term capital gains over 1 lakh rupees. Since there are no changes in this category, the tax implications are clear. Mutual funds holding less than 65% or more than 35% in Indian equity ETFs, or equity funds. In this category, the taxation remains the same as per the previous rules. If the holding period is less than 3 years, the gains are treated as STCG and taxed according to the investor's applicable tax slab. For holding periods exceeding 3 years, the gains are taxed at 20% with the benefit of indexation. Mutual funds holding less than or equal to 35% of Indian equity ETFs, or equity funds. This category witnesses a significant change in taxation if the amendment is passed in Parliament. The gains from these funds will be taxed as per the investor's applicable tax slab, eliminating the distinction between LTCG and STCG. This taxation rule will be effective from the 1st of April 2023. It's worth noting that investments made before the 31st of March 2013 remain eligible for the old tax rules, allowing indexation for long-term capital gains. The amendment has garnered criticism and anger from many investors. While it's understandable that investors may be unhappy with these changes, it's important to recognize that the finance industry's frustration primarily stems from the potential loss of business. Debt mutual fund taxation from the 1st of April 2023. Should you invest in debt mutual funds? Given these changes, is it still worthwhile to consider debt mutual funds for investment? Some funds may modify their mandates to increase exposure to arbitrage opportunities, making them eligible for debt mutual fund indexation beyond the 35% limit. The impact of such mandate changes on fund performance remains uncertain. However, those seeking long-term tax advantages can explore this option. Now, let's discuss the positives and negatives of bank fixed deposits, FDs, and debt mutual funds based on the new tax regime. Safety. Bank FDs provide a guarantee of up to 5 lakh rupees only, as explained in the other video, Safest Short-Term Investment Plans 2023. For complete safety, investors may consider post office term deposits. Debt mutual funds, on the other hand, are market-linked and returns are not guaranteed. They involve certain risks such as interest rate risk, default risk, or credit downgrade risk. Investors willing to take risks for higher returns can explore debt funds now that both FDs and debt funds have similar taxation treatment. However, success or failure cannot be guaranteed. Taxation. Despite the recent changes in debt fund taxation, it may appear that fixed deposits, FDs, have a slight advantage. However, it's essential to consider the tax implications of both options. In the case of bank FDs, taxes are paid on an accrual basis, and the presence of tax deducted at source, TDS, is an additional inconvenience. On the other hand, debt funds are taxed at the time of withdrawal. This distinction gives debt funds an edge over FDs. Comfort. Merely because FDs and debt funds have similar tax treatments doesn't automatically mean FDs are the practical choice. For many individuals who invest on a monthly basis, setting up a monthly FD can be cumbersome. In contrast, mutual funds offer the convenience of systematic investment plans, SIPs, making them the preferred option. Some might argue for recurring deposits, RDs, but it's worth noting that many banks have limited periods for RDs. In practice, mutual funds are often the better choice for the majority of investors. Liquidity. Flexi FDs provide liquidity options. However, regular FDs incur early withdrawal penalties regardless of the duration. In contrast, debt funds typically do not impose exit loads after a certain period. Consequently, debt funds offer greater liquidity at a relatively lower cost compared to bank FDs. Set-off and carry-forward of capital gains and losses. Debt mutual funds classify gains as capital gains, whereas FDs categorize them as income from other sources. This distinction allows investors in debt funds to utilize the set-off and carry-forward benefits for capital gains and losses. Unfortunately, FDs do not offer this feature, limiting their flexibility in managing gains and losses. Considering these factors, it is hoped that mutual fund companies will adjust their mandates to align with the new taxation regulations. Until such changes occur, it may be prudent to adopt a wait-and-watch approach. Investors need not panic about their existing investments. In fact, given the deferred taxation, liquidity advantages, and the ability to set off and carry forward capital gains, debt funds remain a favorable choice for long-term financial goals. Thank you for joining us in this insightful exploration of debt mutual fund taxation and its impact on making informed investment decisions. We hope this video has shed light on the changes in taxation regulations, empowering you to navigate the investment landscape with confidence. If you found this video helpful, we kindly ask you to show your support by liking this video, subscribing to our channel for more valuable content, and sharing it with others who may benefit from this information. By doing so, you contribute to building a community of informed investors who can make sound financial choices. Remember, knowledge is power, and staying informed about the latest developments in debt mutual fund taxation is crucial for maximizing your investment returns. For personalized guidance tailored to your specific needs, we recommend consulting with a financial advisor who can provide expert advice based on your unique financial goals. Thank you once again for watching. We appreciate your support, and we look forward to bringing you more valuable insights to help you on your journey to financial success. Don't forget to like, subscribe, and share this video, and may your investment decisions always be well informed and prosperous.